I'm Chilo from BNP Paribas Investment Partners. In this video, we are going to talk about the RMB foreign exchange policy and outlook. Now, before the Chinese central banks moved to widen the trading band for RMB in March, it intervened in the market to push down the exchange rate. Now, that led some investors to conclude that the Chinese central bank might have shifted its policy to devaluation. Now, we don't agree with that. The RMB has already risen by more than 30% against the dollar since 2005. And on a trade-weighted basis, it has increased by more than 40%. So that means a small devaluation is not going to help. But a large devaluation will not be tolerated by the international community. On the growth side, if we look at net exports, which is one component of GDP. Now, when you look at this chart that I've plotted the net exports contribution to GDP growth in China, along with other components. And it's very clear that since 2009, net exports have been dragging on growth instead of adding to growth in China. So devaluation's impact on growth is going to be very small. Now, some may also argue that China may need a weak RMB to combat deflation. Now, this is not true either. When you look at this other chart, I've plotted Chinese inflation movement over the past 15 to 20 years. Within this period, China has gone through periods of deflation. But the RMB exchange rate has been rising, while economic growth has also been rising. So China doesn't need a weak currency to combat deflation. Now, the RMB's underlying trend is still appreciation because of the external surplus generated by the Chinese economy. Now, to force a devaluation in the face of appreciation underlying pressure, that will generate costs that will likely overwhelm the benefits of devaluation on the Chinese economy. And the notable costs of this policy will likely be imported inflation, which is unwelcome at this time when the Chinese economy is moving downward structurally. And more importantly, a conflict of policy with Beijing's structural reform agenda. Now, to devalue the RMB in the face of an appreciation pressure, the Chinese central banks will have to flood the system with RMB to create excess liquidity. Now, this spillover effect from foreign exchange intervention runs directly against Beijing's reform agenda of deleveraging the economy, pushing through structural reforms by reducing excess liquidity. So when we consider all these factors, it is not in China's best interest to devalue the currency. Beijing's prime goal is to implement structural reforms, but in the short term, it needs a temporary boost to growth to facilitate the reform process. And the RMB exchange rate plays that facilitation role. In the near term, we can expect some more weakness in the RMB exchange rate due to market forces, but the medium-term trend of the currency is still up, albeit with some more volatility compared with its own past. That's it for now. Thanks for watching. I'll see you again next time.